This is Tom Asprey with the MoneyShow.com Video Network. My pleasure today to welcome an old friend, Larry Williams. Hi, Larry.
Hey, Tom. Thanks for being here.
Great. It's exciting. You're celebrating a very long and illustrious trading career. And I know you do a lot of work in forecasting. I know that last year you sent out a quite interesting chart of what your seasonal analysis suggested the stock market was going to do. And it was really spot on. And I think a lot of people were really excited about seasonal analysis and wondered what it was. So maybe if you can explain how you create this chart and then tell us what your forecast looks for 2012.
Sure. What I do that's different in my work is not just cycles. I look at a lot of common cycles, but I think the most important one is the decennial pattern. And then on top of that, I use a 4-year pattern and a 2-year pattern. But more importantly, because it's a lot of work, I go back and find years, every year that looked like 2010, that had basically that pattern, and then said, well, what happens after that pattern appears? And that's significant. And basically 2011 looked a lot like what happened after several different years. I put all that, the cycles and the patterns, in a Cuisinart blender, so to speak, a computer, and then it spits out what should happen the coming year. And it's been really very accurate the last several years. For 2012, it suggests we should rally really strongly right now. Middle of February, 1st of February, good strong rally into March, April, maybe late April, May, and then we come down, Tom.
So that period when we top out in late April, early May, do we go down for the rest of the year?
I don't think we go down for the rest of the year. I mean, a lot of these things about cycles, you have to wait till you get there to see what's the news of the day. What's the technical structure of the market to see is it strong or weak. So that's going to tell us the magnitude. When we get there, we have to look. The cycles are more of a timing. They're not big on magnitude. But so we really need to get into that time period. Already, though, we see one fundamental consideration, the yield spread between short-term and long-term rates, a great predictor of stock prices on a fundamental basis. And the beautiful thing, it has about a 2-year lead time. And it's clear there's a sell signal coming up in April, May of this year. So I would think at this point we should see a pretty good sell-off.
Do you look at the presidential cycle, though? I mean, that's sort of a tendency to, that probably goes into your 4-year analysis, but oftentimes that bodes well for the end of the year.
I do look at it. I first wrote about it in my stock book in 1968 or something like that. And I think it's operative, but it's not mandatory the market follow the presidential cycle. However, part of that presidential cycle, what I call kind of an election phenomenon, it doesn't matter who gets elected, good guy, bad guy, whatever your political beliefs are, the markets rally real strong right after the election. They actually start a rally before the election, pull back, and everybody's nervous who's going to win, and then boom, they take off. So I would look for some strength shortly before the election and then after the election.
Great. Thank you very much, Larry.
Thanks, Tom.
And thank you for joining us on the MoneyShow.com Video Network.